Right now, as we speak, Strive Inc., trading under the ticker symbol ASST on the NASDAQ, is changing hands at approximately $1.06 per share. The stock is currently down roughly 7.00% for the session, struggling to find a solid floor after opening near $1.11 and facing immediate selling pressure that pushed it as low as $1.03 earlier this morning. The chart you are looking at is not just a standard red day. It is a battleground between a highly aggressive new corporate strategy and the cold, hard mathematics of market liquidity. When you see a stock trading just pennies above the critical $1 psychological threshold while simultaneously executing one of the most aggressive pivots in the microcap space, you are not looking at a simple sell-off. You are looking at a repricing event that is testing the conviction of every single shareholder involved. Most investors looking at this 7% drop today will assume the hype is dead. They will look at the red ink, the slide from the pre-market high of $1.14, and assume that the smart money is exiting the building. That is the expectation, that a small-cap company which recently surged is now entering the dump phase of a pump-and-dump cycle. However, the reality is far more nuanced and, frankly, far more interesting. What we are witnessing is likely a volatility tax, a necessary, albeit painful, consolidation phase following the massive structural changes this company has undergone in the last few months. This is not just a tech company failing to deliver earnings. This is a company that has fundamentally altered its DNA to become a Bitcoin treasury vehicle, and the market is still trying to figure out how to value that transformation in real time. The drop you see today is arguably the market flushing out the short-term retail traders who bought the headline but don't understand the balance sheet mechanics, leaving the stock in the hands of those betting on the longer-term Bitcoin proxy thesis. To understand why this price action is happening right now, we have to look closely at the intraday mechanics. The stock opened at $1.11, already weaker than the previous close of $1.13, and immediately saw a flush. This type of open drive lower often signals that overnight limit orders were pulled or that a large seller decided to hit the bid right at the bell. The volume we are seeing, over 24 million shares traded already, indicates massive turnover. This isn't low-volume drift. This is a high-volume exchange of ownership. The stock found temporary support at $1.03 around 9:45 a.m. EST, a level that is crucial because it aligns with technical support from previous consolidation zones. If $1.03 fails, the road to sub-$1 becomes slippery, and that brings in a whole new set of algorithmic trading pressures related to NASDAQ compliance and penny stock liquidity traps. However, the fact that it bounced off of $1.03 and is trying to reclaim the $1.06 level suggests there is a bid underlying this selling pressure, likely from institutional or high-net-worth accounts that are accumulating shares for the macro strategy rather than the daily scalp. Let's pull back and look at the company itself, because the name Strive Inc. and the ticker ASST represent a fascinating evolution in the public markets. Until recently, this ticker belonged to Asset Entities Inc., a company focused on digital marketing, Discord community management, and social media content. If you look at older reports, that is what you will find. But that reality is outdated. In September 2025, Asset Entities completed a merger with Strive Enterprises, effectively transforming the public entity. This wasn't just a name change, it was a total strategic overhaul. Strive Inc. is now positioning itself as a Bitcoin treasury company. If that sounds familiar, it is because they are effectively adopting the playbook popularized by MicroStrategy. The goal is to issue equity and debt, specifically their new Series A perpetual preferred stock, to raise cash and buy Bitcoin, aiming to increase the amount of Bitcoin per share for common stockholders. This is why the stock is so volatile. You aren't just buying a company, you are buying a leveraged bet on Bitcoin execution. This context explains the violent swings we are seeing today. Yesterday, the stock was up significantly, driven by the excitement surrounding their recent capital raises and Bitcoin purchases. Today's 7% drop is the hangover. It is the market digesting the dilution risk associated with their SATA preferred stock offering. When a company announces they are raising millions of dollars, in this case closing a $160 million upsized offering, the immediate reaction is often fear of dilution. Investors worry that their slice of the pie is getting smaller. However, the counter-argument, and the one the bulls are banking on, is that if the capital raised is used to buy Bitcoin, and Bitcoin appreciates, the value per share increases despite the higher share count. This is the accretive dilution theory. Today's red candle is the market asking, can they actually pull this off, or will they just dilute us to zero? We also need to talk about the Vivek Ramaswamy factor. The search for safety and authority in microcaps often leads investors to follow big names. Vivek Ramaswamy, a former presidential candidate and co-founder of Strive Asset Management, is a significant shareholder, reportedly a 10% owner. His involvement adds a layer of credibility that most $1 stocks simply do not have. It brings media attention, it brings a certain level of serious intent, and it keeps the stock on the radar of retail investors who might otherwise ignore a microcap. However, celebrity involvement also increases volatility. It attracts emotional trading, people buying because of the name rather than the numbers. When the stock dips 7% like it is doing today, those emotional traders are the first to panic sell, exacerbating the downward move. Now, I want to address the short selling dynamics because this is critical for anyone holding ASST right now. When a stock undergoes a massive pivot and spikes in price, it attracts short sellers like sharks to chum. They look for fade opportunities, betting that the hype will die down and the price will revert to its pre-merger mean. With ASST trading near $1, it is a prime target for shorts who believe the Bitcoin treasury narrative is just a buzzword designed to pump the stock. You need to be watching the borrow rates. On many brokerage platforms, hard-to-borrow fees for stocks like ASST can skyrocket to 50, 100, or even higher annually. If you see the stock price stabilize and refuse to go below $1 despite heavy selling, it could trap these shorts. Specifically, look for failure to deliver data in the coming weeks. Often with these high-volume, low-float stocks, market makers and aggressive short funds will sell shares they haven't yet located, leading to a spike in FTDs. If the stock suddenly rips higher on no news, it is often a forced buy-in event where these shorts are covering their positions to avoid regulatory penalties or margin calls. Right now, the pressure is on the downside, but if Bitcoin were to suddenly rally $5,000 in a day, ASST would act as a leveraged derivative, ripping higher and squeezing those shorts instantly. This correlation with the crypto market adds a layer of systematic risk that you cannot ignore. You are not just trading ASST, you are trading the sentiment of the entire crypto sector. Speaking of sentiment, I want to hear from you. The strategy Strive is employing, selling stock to buy Bitcoin, is controversial. Some call it genius, others call it a Ponzi-like structure dependent on eternal crypto appreciation. What is your take? Comment below with genius if you think this is the future of corporate treasury management, or trap if you think this ends badly for the common shareholder. I read every comment and I want to gauge the room on this one. Let's look deeper into the technicals on the daily chart. Before this recent volatility, ASST as asset entities had been drifting lower, a victim of the general disinterest in small-cap tech. The merger news injected a massive volume spike. The 52-week high is sitting way up at $13.40, adjusted for splits or past volatility, while the low is down at 34 cents. We are currently trading much closer to the lows than the highs. This $1 to $1.10 zone is forming what technical analysts might call a base, but it's a fragile one. A break below the 52-week low of 34 cents is unlikely given the new capitalization, but a retest of the 0.80 or 0.90 level is entirely possible if the $1 support cracks. The volume-weighted average price for today is likely sitting above the current price, indicating that the average buyer today is underwater. This creates overhead supply. Anyone who bought this morning at 110 cents is now waiting for a bounce to sell at break-even, which acts as resistance. We must also consider the business fundamentals that remain from the asset entity side. While the Bitcoin treasury is the headline, the company still reportedly operates its digital marketing and Discord services. Revenue from these legacy operations was modest, often in the low millions with significant net losses. The merger documents suggest a shift in focus, but these operational assets still exist. Are they being sold off? Are they being integrated? The lack of clarity on the operational business is a risk factor. If Bitcoin goes sideways for 2 years, the company needs cash flow to pay its bills. If they don't have operational cash flow, they have to sell more stock, dilution, or sell Bitcoin, defeating the purpose. This cash burn versus Bitcoin accumulation is the fundamental equation you must solve before investing. Institutional activity is another layer to peel back. Usually stocks trading at $1 have very low institutional ownership. It's mostly retail. But with the Strive merger, we might start seeing different types of F-13 filings. Strive Asset Management itself manages funds, and while there are strict rules about self-dealing, the network of investors associated with Ramaswamy and the Strive ethos, anti-ESG, pro-energy, pro-Bitcoin, suggests that there could be friendly capital parked in this stock. This is different from a random penny stock where the only institutional money is predatory convertible debt holders. Here, you might have ideological capital supporting the price, which could put a floor under the stock that technical analysis alone wouldn't predict. Let's